So this is the second problem that is really just principally rests upon the idea of the LIFO reserve. Um, if you haven't watched the Chapter 9 video about me going through the LIFO reserve problem in the other format, I would suggest you do that first. This one's going to have a little bit of, go a little faster because there's a bit more of an understanding and there's less of the financial statement context in this particular example. So what you're given is just a little bit of data between LIFO and FIFO. And it says that this information was taken from Half regarding its inventory disclosures. And we have some values at the end of the year X7, at the end of the year X8. So what this, hopefully you can start interpreting in an accounting brain. This is my beginning, this is my ending balances, right, of my inventory under these two cost flow methods. And, we see the general pattern is emerging that during times of rising inventory costs, that LIFO tends to report lower ending inventories and FIFO tends to report higher ones. Remember, FIFO is based on those older units, LIFO is based on those recent units purchased. And then it also gives me a little information. It says that they report cost of goods sold in the amount of 983,000 during the year 20x8 using a FIFO cost method. So, of course, recognize that this, these two values are bookends for the year 20x8. So that means that the year 20x8 happened between these two endpoints. So we're getting that income effect between the two balances. And then that's using a FIFO cost method. So that's FIFO COGS. It asked me to determine LIFO cost of goods sold. Now we can only do this because we have information about both of the accounts in a LIFO and a non-LIFO method. And we can then construct the LIFO reserve account and see what adjustment had to have happened during the year. And we can construct this because all we need to remember is that the balances of the LIFO reserve account are just the difference in the company's recording inventory under the non-LIFO method minus the LIFO method. And so this is our beginning balance. 235 minus 221 is 14,000. And 252 less 234 is 18,000. So once we have the balances, then it becomes more apparent, well, what adjustment had to have taken place in order to get that balance to switch. And this is my adjusting entry for the LIFO reserve. I need a credit, so I'm going to credit the LIFO reserve for 4,000. And I need a debit to cost of goods sold. So that reduces my income. The company switching from non-LIFO reporting in their ledger to LIFO reporting on their financials. The effect of that is, in this case, going to reduce net income and also reduce assets because LIFO reserve is a contra asset account, a contra attached to the inventory account. So it'll reduce inventory by another 4,000. Applying this, we can easily determine what the cost of goods sold would be as we adjust from the FIFO COGS of 983 to the LIFO COGS. And I mean, if it helps, think of it in terms of really what's going on is my cost of goods sold is already at 983. This is its unadjusted balance. And then we have this entry as an adjusting entry, adding 4,000. And so its adjusted balance is what would appear on the income statement now properly at LIFO COGS because we performed the LIFO reserve adjustment. Okay, so really easy sort of manipulation, but like I've always said or say in class, you got to understand what the numbers are telling you to make the story fall out easily. Otherwise, you're just going to perhaps jumble them up or, make a mistake. But, understand what the company's trying to do, why it makes sense, why things move the way they are. That's when you'll be able to tackle any question about life reserve.